Yesterday, the Bank of Canada raised their key interest rate to 5%, which is the highest it's been since 2001. Why are they doing this? So, the theory behind it is the more expensive it is to borrow money, the less likely people are to spend it. One of the factors the Bank of Canada will look at is the labor market, wages, and unemployment rate. And the idea, again, is to cool spending by people having to pay down debt rather than buy stuff, because, buying more stuff is what's driving the demand that's driving up the cost of everything. Now, despite all the growth in spending that there's been recently since the pandemic, we still haven't approached pre-pandemic levels of spending. So the Bank of Canada really seems to be focusing on the consumer side and the labor side. So basically taking the position that inflation is being driven by too many people being employed and making too much money. Now, if you're like me, something about that doesn't sit right with you because it's not talking about the record excess windfall profits that are being collected by corporations at this time. The latest report on wealth distribution in Canada from Statistics Canada demonstrates that the ever-widening wealth gap is being driven by high returns on investment, so shareholders being paid out more. And we see this in Canada with the trend of groceries outpacing inflation with no end in sight, apparently. And to economists who argue that businesses are incentivized to raise profits and can do so at any time, so why now? I say thank you for making my point for me. Consumer spending has not exceeded pre-pandemic levels yet, and consumers can spend whatever they want at any time because they have credit. And these raises in interest rates have not quelled consumer spending at all, apparently. It's not even registering as a factor in inflation, according to the Bank of Canada itself. And to the economists saying this, I say thank you.